In the era of high interest rate, does it make more sense to pay down mortgage first? Average annual return of SP 500 is 7ish, and you need to pay tax and there is risk of short-term volatility. Right now 30-year mortgage is 6.7. This is risk-free and we don't pay tax. And I don't see rate going down in the near future. So in that case, should we pay down mortgage first instead of contributing to SP 500 monthly? If you have a 6.7 interest rate, there is absolutely no downside to paying it down. You're unlikely to get a better return anywhere else. Anything above 5 is probably a good idea to focus on paying down in my mind. You can think of it as buying on margin. Would you borrow at 6.7 to buy SP 500? I personally would do that for something very low, like 2, but not anything above 5 unless I think I can time the market. Trick is to prepare yourself for FOMO. I focused on paying medium interest debts in the early 2010s and in hindsight missed out on a lot of market recovery growth. But that wasn't guaranteed, and loan interest is. I paid off my home 5 years ago. There is an indefinable feeling of being debt-free. The stress of life goes away. The savings that we've managed to accumulate since then is also pretty amazing in a year. Yes, rates are low and you may be able to parlay your savings into more, but there is something to be said of head-on-the-pillow factor that can't be discounted. Paying down your mortgage is tax-free return though, so even if you think you can get 7 returns, it's probably still better to pay a 6.7 loan, and that's before you factor in volatility there. The mortgage is a guaranteed return. I would say if you can get higher gross returns from treasuries, then that is an indication your mortgage is low enough rate where it might make sense to invest it instead. Right now that mortgage rate would be about 4 something for more people. The higher your tax rate, the lower that would be. The average annual return of the SP 500 is around 10, not 7. You might have gotten 7 by adjusting for inflation, but all investments and mortgages are affected by inflation similarly, so 10 is the number that's relevant. Taxes are significant too, yes, but tax-advantaged accounts like HSAs go a long way in mitigating what you actually owe. With that said, it still may be best to pay off the mortgage. Unless you're completely indifferent to volatility, 6.7 guaranteed return is hard to beat. I would make sure I have no other high-interest debt first and make sure I'm getting at least 15-20 into retirement accounts and then heavily pay off any mortgage over 5. You likely could make more long-term in the market, but there are risk factors at play here that many do not consider. There may be some wiggle room here if you are younger. Our mortgage is 2.9 and we are not paying that down aggressively. I'm early 40s and invest the difference between a 30 and 15 into a separate brokerage. How much do you value peace and security of having a paid-down home? You pay your mortgage with post-tax income, so it's the same as a guaranteed 11 or 12 return. I'm torn on this subject as well. Personally, I'm just damaged as I came from an immigrant small business family, and as a child I was constantly reminded that the business could go under any time, and we'd be living under the bridge. For that reason, I don't like I make multiple extra payments on my 3.5 mortgage every year. I don't think I'll stop anytime soon, even if the yield on HISAs go even higher. I mention HISAs because that's the safest place to park money emo. I want to own my house outright ASAP. That's the real American dream emo. You can't compound the mortgage beyond what the debt amount is. The SP 500 can compound 6-7 year after year for 30 years. I've never met anyone who's regretted paying down their home faster. With a high rate, sure it's just fine to pay it down. But the S&P is higher than a 7 nominal return. What time frame are you saying 7 for? Can someone factor paying 110 of principal down in the first 2 years on an original 350k 30-year mortgage 3.5 to save total interest over the length of what is left? I'm in a similar boat as you. I'm going to buy down my mortgage. But I know if I could invest for 5 years and then refinance, then it would be the best of both worlds. But I don't have the cash flow to do that, so I'll be sinking all my savings most into my mortgage. One major difference is that you get a tax break on your mortgage while you get taxed on stock gains. I don't think paying down debt is ever bad, but there are cases when it doesn't make sense. And I don't see rate going down in the near future. Stop with this. You have no idea what the Fed is going to do. The average annual return is 7 above inflation. Makes a lot of difference. But yes, I'd pay down the 7-interest mortgage. In general, pay down the debt with the highest interest rate first. It's usually credit cards. 7 is still better than 6.7, and the 7 is liquid and can be turned to cash anytime, whereas the 6.7 cannot be. But when the rates are similar, generally speaking, paying down debts is a good thing. A lot of our Wall Street Bets subscribers here as well, I see. Whatever you want to do, always remember that cash is king. Depends on your marginal tax rate and assume time value of money. Typically, higher income people benefit more from having outstanding debt due to deductions. I have to do the calculations for most of my clients. Yes, if you are organizing a 30 years fixed rate at that rate. Most people have much lower rate. This brings up an interesting question. I'm new to economics. What happens when inflation interest rates are higher than the usual 7 stock market rate? Why would anyone want to invest in stock market? What would people invest in? Government bonds and tips. If you plan to live in the house for 5 years, not sure paying more makes more sense or not. But if it goes back to 8, by all means, especially the last few years left. One saves a lot. SP 507 return isn't guaranteed. It can go down even negative. Just because we had a good run means it will stay that way. My mortgage is 1.5, so I'm not paying it down as HISA gives me 5. Once my mortgage goes over the HISA rate, I will pay it more. But I will also keep investing. The fact that people are buying houses at 7 and paying 300k is mind-blowing. I work in a tax office and literally had to go over how much they'd be paying the bank and taxes on their house over 30 years so many times. Where does being able to refinance later on come into play with the math here? Does that even matter? You can refinance in 3 years, which will lower your average interest rate. SP 500 average is 7.10 a year after inflation. Your mortgage rate is fixed and essentially loses value to the inflation rate as your salary is increasing against it in real dollar terms. Just this year the SP and Nasdaq are up over 20. Invest your money, and when it's enough you sell at the long-term capital gains rate and pay off your house early. Has everyone forgotten our property value increases also have tax consequences? Yes, I see many comments where property tax increases are being ignored and need to be figured into the equation as an investment cost. 3 questions you need to ask yourself before you start with extra payments. 1. Is your interest rate higher than inflation? 2. Can you figure something out that would be a better investment? 3. Are you comfortable holding debt? It sounds like that may be a good idea for you right now, but keep these in mind periodically. 60 of mortgage holders have a rate below 4. About 90 below 6. This explains housing inventory shortage. No one wants to sell and get trapped into 7 mortgage. Depends on how long you want to be a slave for, and how rich you want to be in the end. Yes. It's worth paying down any loan over 6 before you invest a penny in the stock market. The only exception would be a 401k. You should contribute enough to get the full employer match and prioritize that above paying down the loan.